Hello and a very warm good evening, everyone. I welcome you all to this highly anticipated online webinar on options trading strategies and algo trading, organized by Committee of Financial Market and Investor Protection (ICAI). I'm truly honored to stand before you as we gather here today to delve into the intricacies of stock market trading with the insights of a highly esteemed speaker who have made a remarkable contribution to the field. Before we embark on this intellectual journey, it is my privilege to introduce C.A. Nand Lal Kishnani, a seasoned professional in the financial landscape with a distinguished career as a practicing chartered accountant since 1992. Mr. Kishnani has been driving force in the industry for several decades. A member of both the National Stock Exchange and Bombay Stock Exchange since 2009, Mr. Kishnani has actively engaged in proprietary trading in futures and options, showcasing a keen understanding of the market dynamics and trends. He is a multifaceted professional whose journey reflects a profound commitment to excellence in the realms of finance, technology, and market innovation. Let's all join our hands together to welcome C.A. Nand Lal Kishnani. Over to you, sir.
Good evening, everyone. I want to express my sincere gratitude to the chairman, committee chairman, C.A. Charanjot Singh Nandaji, vice chairman, C.A. Srinivasji, for providing me this opportunity, and want to thank moderator C.A. Nayar Utgiji for warm introduction. It's truly an honor to be here, and I appreciate the opportunity to engage with such a diverse and dynamic group of chartered accountants. I welcome all of you joining from various corners of India. Today's webinar promises to be a journey filled with insights and knowledge sharing. I will try to make this webinar an engaging and enlightening experience for all of us. So let's embark on this intellectual adventure together. Once again, thank you to the moderator and a warm welcome to each one of you. This is a standard disclaimer that I am not registered as a financial advisor. This is for educational information purpose only and should not be considered as a financial advice. Any action you take based on the information provided will be at your own risk. Indian capital market has seen a nice boom in last few years, and tens of millions of new investors entered the stock market. There has been a flood of financial influencers, trainers, self-proclaimed trading experts on various social media platforms. There are plenty of people willing to sell their services. Many will promise you the moon. Many people have suffered losses after being lured by the promise of trading riches. Trainers who claim to make huge profits due to their superior trading skills have actually incurred losses and have been hiding their losses. Several high-profile traders have consistently made false claims that they earn profit just to lure people for buying their online trading courses, or earn referral income or brokerage from their accounts opened through them, or earn income from YouTube. SEBI study says that 90% of the people who trade derivatives lose money. And it found that the number of clients of top 10 brokers had jumped to 452 lakh by financial year 2022. So another study says less than 1% of active traders earn more than bank FD over 3 years time frame. Today we will learn how can we enter in the 1% profitable club. Today we will discuss about the strategies and insights that can elevate us to the esteemed 1+ club of traders who earn more than bank FDs. The great confusion where to get started. Many people want to enter this crazy world of infinite possibilities, but don't know where to get started. There are million different strategies. After all, you can trade futures, equities, forex, commodities, crypto. You can make money buying. You can make money by selling short. Mathematical and statistical models. There are technical studies. Then there are fundamental studies. Then navigating the intricacy option itself is such a huge subject. Understanding call options, put options, strike prices, ITM, ATM, OTM. There are so many concepts to understand. So many different strategies are there, like straddle, strangle, butterfly, iron control, bull put spread, and so on. Truly comprehending the dynamics of these elements requires not just months, but years of dedicated learning. So there are so many things to study. It can be overwhelming trying to figure out where to focus our efforts. Whether to start with investing or trading. There are two different approaches. One is long-term and one is short-term trading. Both approaches have different risk and time involved. It's okay to do both, and it depends on the risk-taking ability and patience of the person to choose between either of these or both. Both earn profits, but traders often earn more profit compared to investors when they make the right decisions and the market is performing accordingly. Everyone would have heard about Warren Buffett, but very few would have heard about Jim Simon. Jim Simon was a professor in a university. He's a great mathematician. And Warren Buffett has been investing since long. So here's a comparison of Warren Buffett and Jim Simon. So investment style, Warren Buffett employs a long-term value-driven approach with a focus on the intrinsic value of the company. And Simon relies on sophisticated quantitative models and mathematical algorithms to make investment decisions. Warren Buffett employs long-term investing, and his holding period for stocks often goes for years. And Simon's strategies involve frequent trading and can be considered short to medium term in nature. Here's a CAGR. Buffett has been able to generate 22% annually, and Jim Simon has compounded money at 66% annually since 1988. Net worth of Buffett is 106. Sorry, it's not rupees, it is dollars. $106 billion as on December 2023. And Jim Simon net worth is $28.1 billion. Richest people rank, Warren Buffett is 5th richest, and Jim Simon rank is 49th. The Man Who Solved the Market is authored by Gregory Zuckerman, and this has been taken from the book. Since 1988, Jim's flagship medallion fund has generated average annual returns of 66%. No one in the investment world comes close. Warren Buffett, George Soros, Peter Lynch, Steve Cohen, and Ray Dalio all fall short. Buffett has compounded at roughly 22% annually, a third as much. What's the learning? That both investing and trading earn money. And the learning is that traders can earn more profit compared to investors because traders can earn money selling shorts as well. There is a rule of 72. How many of you are aware about rule of 72? If an investment has an annual return of 8%, according to rule of 72, how many years will it take to double your money? Rule of 72 says that you divide 72 by the return percentage and you will get roughly approximate idea. Like here, if we divide 72 by 8, so it will take 9 years to double the money. Albert Einstein says compounding interest is the eighth wonder of the it earns it, and he who doesn't pays it. Einstein recognized the incredible power of compounding, highlighting its potential for both wealth creation and debt accumulation. This is a compounding table comparison. Amount invested 1 lakh rupees. At 7%, if you want 7% return, then amount is doubled in approximately 10 years. And if you are earning 14% return, then amount doubles in 5 years. So if you invested 1 lakh rupees, in next 5 years, it will become 2 lakhs. And again, in next 5 years, it will become 4 lakhs. So it will get multiplied by 4 times in 10 years. And here, if you are earning 7%, it will double in 10 years. So if we compare after next 10 years, means in 20 years, it becomes 16 lakh. And if you are getting 7% return, it's getting 4 lakh only. It's a comparison till 60 years. In 60 years, 1 lakh invested becomes roughly 41 crores. And if you are running at 7%, it is just 64 lakhs. This table just shows that compounding is the magic actually. Now, if we come to again comparison of Warren Buffett and Jim Simon, Warren Buffett's net worth is 106 billion and Jim Simon 28 billion. So why this difference? Because of the compounding years, Warren Buffett got 82 years to compound his wealth, and Jim Simon just got 34 years. Warren Buffett is 92 years, and Jim Simon is 84 years. Warren Buffett has been investing since the age 10, and Jim Simon started trading since age 50. There is one article I'll show you. There is one article in CNBC where he is comparing Jim Simon and Warren Buffett. He says, why the difference? Simon net worth is just 23 billion. This article is some 2 years back, September 2020. At that time, his net worth was 23 billion. And he is comparing with Buffett. He is 72% less rich than Buffett. Why the difference? If Simon is such a better investor, because Simon did not find his investment stride until he was 50 years old. He had less than half as many years to compound as Buffett. Had Simon earned his 66% annual returns for the 70 years span Buffett has built his wealth, he'd be worth, please hold your breath. This is a quadrillion figure. Green कैसे पीछे मिले Sorry, one moment. So what the learning here, the sooner you start saving your money, more likely it is that you will never face a lack of money for or financial stress. So John Wesley quote, earn as much as you can, save as much as you can, invest as much as you can, give as much as you can. So what the learning is maximize, we have to maximize our returns. And the benefits are it creates emergency fund, long-term goals are fulfilled, and retirement planning is done. And second learning is start saving early. What are two biggest expenses in life for HNIs? The biggest expenses, one is tax. If you earn a crore of rupees, you have to pay 30% tax. And another biggest expenses is ignorance. If you can make 5 lakh rupees per month and you are making only 2 lakh a month due to ignorance. So if you have shares, investment, idle lying in your demat account, that you can play with the NSE and get margin for trading against those shares, and you can deploy strategy in options where probability of win is almost 100%. Just back we saw that if you earn 7% return in FD, and if you are paying tax, so after tax return comes to 5%, net return comes to 5% after tax. So if you compound that money, it makes a lot of difference in long term. Second example of ignorance, if you are operating a successful and lucrative business, you are considering potential stake dilution through an IPO or daunting prospect and potentially limiting the scope for further personal and organizational growth. IPO empowers growth, amplify your business potential without diluting your vision. As chartered accountants, we play a pivotal role in guiding our clients through the intricacies of tax laws, helping them optimize their financial position and ensuring compliance with the ever-evolving tax regulations. We can help our clients optimize their income streams to reduce the overall tax burden. Where to invest money? These are the four topmost options for investing money. One is the stock market, real estate, digital gold, and mutual funds. We will discuss here investment in the stock market. You do not need money to make money on every stock you pick. If 5 out of 10 stocks in a portfolio are winners, it will produce a satisfying result, because winner can become multi-baggers, like 5 baggers or 10 baggers, but your losers are limited to the amount you invested. It cannot lower than zero. Sometimes even a single multi-bagger can overwhelm the minuses from the stocks that do not work out. There are many examples like Infosys, Titan, Wipro, Microsoft, etc. To invest successfully does not require extremely high IQ, unusual business insights, or inside information. Irrespective of educational background and specialization, anyone can learn the tactics of successful investing. People who are intelligent enough lose money, and ignorant people who does not have knowledge about the stock market make fortunes. It is simple but not easy. Simple in the sense that it does not require high intellectual. Not easy because it requires years of practice, discipline, dedication, and willingness to learn. Everybody would have heard about Newton's law of motion and law of gravity. He was a great mathematician and physicist of all times. Newton has purchased the share in South Asia Company in the year 1720, the hottest stock in England at the time. Newton sold his South Sea shares, pocketing 100% profit, totaling £7,000. But just a month later, bought again in the wild enthusiasm at much higher price and lost £20,000 in the year 1720. You could imagine the value of £20,000 in the year 1720, 300 years ago. This is the chart of South Sea stock, where Newton invested a bit, then exit happy. Newton's friends get rich. Newton re-enters with a lot, and Newton exits broke after 10-12 months. Similarly, SEC share, which had a market price of 200 per share, skyrocketed to 9,000 per share in just 3 months. As share price were artificially increased. People got carried away and made a wrong investment without doing research or homework. When technology stock bubble was there in 1990s, share price of technology stock were artificially increased. The price soon started falling when the technology stock bubble burst. I myself lost at that time. So what's the learning? Without patience, discipline, and risk management, even high IQ and higher educations are not enough to make trader or investor successful. Risk management and position sizing. While the pursuit of return is inherent in investing, preserving capital and managing risk are equally crucial for sustained success. Strategies where probability of win is almost 100%, like ratio spread, one can deploy a large amount of his capital in such strategies. The strategies where win percentage is less, but ROI is higher, like buying future and put, one need to deploy lesser amount of his total capital. So we'll discuss about techniques of analyzing security. What are Warren Buffett's investment principles? He understands their business. The company valuation is quite attractive. Company is led by competent management. The long-term prospects of a company are good. It's a quote from Warren Buffett: never invest in a business you cannot understand. Price is what you pay and value is what you get. Never invest in any company before you have done homework on the company's earning prospect, financial condition, price earning ratio, shareholding, competitive position, management team, dividends, cash flows, etc. The stock market is filled with the individual who know the price of everything but the value of nothing. It's a quote by Philip Fisher. Buy and homework is a phrase popularized by former hedge fund manager and TV personality Jim Cramer. Jim Cramer, host of the CNBC show Mad Money, coined and popularized the phrase buy and homework. Investors need to actively stay informed about their holdings by spending at least 1 hour a week researching each stock position in their portfolio. It's a quote by Peter Lynch: know what you own and know why you own it. If you do not have time to study and do homework and analyze yourself, you should not invest in individual stocks. Simply invest in index ETF, say Nifty ETF, and you will always stay invested in India's top 50 stocks according to market capitalization. Of the below options, which is more difficult to manipulate? So of course, individual stocks are easy to manipulate. Nifty index has 50 stocks in it, so it's very difficult to manipulate Nifty index. So the indices chart of NSE. Total Nifty 500 companies are there. They're divided in large cap, Nifty 100, then Nifty mid cap, 150 companies, then Nifty small cap, 250 companies. Nifty 100 are further divided in Nifty 50, Nifty next 50. For all these indices, ETFs are available. We can, instead of investing in individual stocks, we can just invest in indices ETF. If we want to invest in mid-cap stocks, then we can purchase Nifty mid-cap ETF. If we wish to invest in Nifty small-cap companies, then we can buy Nifty small-cap ETF. India's ETF flow hit record in 2023. India focus ETFs saw net inflow of rupees 8.6 billion last year, according to data by Morningstar Direct. What are the types of ETFs? Index ETF, just now we discussed that Nifty, Bank Nifty index are there, mid-cap index is there, small-cap index is there. Then global indexes are available, Nasdaq 100, Hang Seng, etc. Commodity ETF, we can invest in gold ETF. Government securities and bond ETFs are available. Then sector-wise ETFs are also available if you want to invest in infra companies or consumer goods companies. So there are many types of ETFs available. This is the tabular comparison of investing in stocks, investing in index fund or ETF. If you invest in index fund or ETF, diversification, you are already diversified by investing in index fund. You need not invest in individual stocks. Individual stocks may lose all its value and become zero. But if you invest in index fund or ETF, likelihood of becoming zero is nil. Another benefit is low management fee. In index ETF, management fee is very low. Index fund are passively managed. The holding of index fund rarely changes. And in mutual fund, cost and management fee is usually higher. ETF funds have lower turnover ratio than actively managed funds. Index fund turnover ratio are usually about 1 to 2% per year. And turnover ratio is usually 20% or higher for some actively managed mutual funds. Funds with lower turnover ratio accrue capital gain less often, which result in less taxes owed by the fund's investors. And in case of mutual funds, turnover ratio accrue capital gains and the burden is shifted to the investors. Investment structure. ETFs are traded like individual stocks in the market. Like in secondary market, you can buy even a single share. An index fund traded at the end of the day at the NAV. Any transactions are processed after the market closes. And the amount you need to invest in ETF, there is no set minimum amount. Even you can invest 100 rupees. Investor can buy as little as one share, making them accessible for investors with any budget. In case of mutual fund, minimum investment amount is decided by the mutual fund. Liquidity. ETFs are more liquid due to being traded on stock exchanges and their prices are continuously updated throughout the trading day. Index fund trade at the end of the day and prices are based on the NAV. ETFs are more tax efficient because of low turnover ratio. And in case of index fund, capital gains are higher and taxes are distributed to the investors. Buffett bet $1 million in 2007. Buffett bet $1 million that over the course of a decade, a simple index fund would outperform a basket of hand-picked hedge funds. Hedge fund manager Ted Seeds accepted that bet and picked the 5 funds. The outcome, Buffett triumphed decisively. Buffett shared a final scorecard of the bet in his 2017 shareholder letter. The index fund he selected delivered a total gain of 125.8% during the decade. while the five funds of funds reported respective gains of 21% for 21.7, 42.3, 87, 2.8, 27 during the same period. Buffet gave all the proceeds to charity, and Gulf Inc. of Omaha turned out to be a biggest winner of the bet. This is the return profile of Nifty 50, so Nifty index. Since beginning, it has given 14.2% CAGR. Index in long term gives good returns actually. So what we learn, if you do not have time to study and do homework, simply invest in index ETF. When was the first exchange traded fund in India launched? We will come to that in next slide. Nifty Bees is the very first exchange traded fund launched in India, and it tracks the Nifty 50 index. It was introduced in India by Benchmark Asset Management on December 2001. After some change of hands, it now belongs to Nippon India Mutual Fund. The Nifty in its name represents the index that it tracks, and Bees is a short for benchmark exchange traded schemes. Nifty index is rebalanced half yearly. When hit with the recession or declines, you must stay the course. And the markets have shown that they will recover. Make sure you are a part of those recoveries. No one could invest when the market crashed to 7,500 in March 2020. Here we see this big red candle is 2008 global recession was there. But in long term, Nifty appreciates. How much should you be investing? The sweet spot, according to expert, seems to be 15% of your pre-tax monthly income. Investing not only helps you build wealth, but it also secures a nest egg for when it's time to retire. According to me, even if a person is earning 20,000 a month, at least 3,000, 15% of 20,000, he should invest each month in index ETF. So Warren Buffett quote, do not say what is left after spending, but spend what is left after saving. So another question, if you are 40 years old, according to the rule of 100, what is the rule of 100? What percentage of your portfolio saving might be allocated to stocks? Rule of 100 says that if you are 40 years old, then 60% you should invest in your portfolio saving might be allocated to stocks. You have to deduct your age from 100. Nowadays, this is a very hot topic these days. Many investor shares are being transferred to Investor Education and Protection Fund Authority in relation to unclaimed shares and dividends. When the shareholder fails to claim dividend for 7 consecutive years, that dividend and shares are transferred to Investor Education and Protection Fund Authority. Now we'll discuss something about options. Options are the art of wealth creation. Explaining options and their various strategies comprehensively within a 3-hour time frame can be challenging given the depth and complexity of the subject. The goal is to instill understanding and equip participant with the essential knowledge in the world of options trading and investing. We will learn how by integrating option strategies with a focus on risk management and discipline, we can navigate the markets and earn reasonable returns ranging from 15% to 30%. Investment in the stock market are subject to market risk, but option can be used as shield to save investors from market uncertainties and unreasonable return also. So again, navigating the intricacies of option alone is an extensive journey encompassing concepts such as call options, put options, strike prices, moneyness, what is ATM, what is OTM, then option chain, open interest, put call ratio, max pain, implied volatility, option premium, calculations. In the nuanced world of option, Greeks, delta, gamma, theta, vega, it's a very huge subject. Options are derivative contracts. Derivative contracts means it's deriving value from the underlying that grant the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price known as the strike price within a specified period. Now we'll take one example. So before learning the strategies, we need to understand the basics of options, what is call, what is put. Otherwise, you will not be able to understand the strategies. Let us take this example. This is the option chain of Reliance. Reliance today's close price was 2716. On the left hand side, it's a call data. On the right hand side, it is put data. So if we come at the definition again, what it says, options are derivative contracts that grant the holder the right. So there are two types of options. One is call option, one is put option. So if we consider call options, this predetermined price, they are the strike prices. Various strike prices are determined by NSE. In the center, it's given strike. Like 2720, 2740, 2760. So again, against each strike price, Here bid and ask price is given. For 2780 call of Reliance, the premium is 690, buyer is 6.90, and seller is at 7.10. So if I buy a call of Reliance, say 2800 strike price call, I'm buying at ₹5 rupees. So what does it mean? If I am buying, I have the right, but not the obligation. I don't have any obligation to buy or sell an underlying asset. Underlying asset in this case is Reliance at a predetermined price, that is a strike price. If I have purchased 2800 call for 5 rupees, so my loss is limited to 5 rupees. And within a specified period means this option chain, its expiry date is 25th January. So if I have purchased a Reliance call of 2800 strike at 5 rupees, by the time till 25th January, if Reliance price goes above 2800, only then I'll be in profit. Otherwise, I'll lose the premium paid. So this basic understanding is needed to understand the strategies. What are key components of options? Strike price. Strike price is an agreed upon price at which the underlying asset can be bought or sold when the option is exercised. Expiration date, in our this case, was 25th January. Stock features, we have monthly expiry only, like 25th January, 29th February, 28th March. And premium, premium is the price paid by the option buyer to the option seller for the rights conveyed by the option. This type of option, call option and put option. Call option gives the holder the right to buy the underlying asset at a predetermined price known as the strike price before or at option expiration date. Put options give the holder the right to sell the underlying asset at a predetermined price. If I feel that Reliance will go down, I can buy a put option like 2700 put option, I can buy at 14 rupees. If I think it will be down, it will go less than 2600 rupees, then I can buy a 2600 call at 1 rupee. Options are contract that give the buyer the right, but not the obligation to buy or sell a specified underlying at a set price on or before a specified date. If I am buying a call, means I am bullish. If I am selling a call, means I am bearish. In case of put, if I am buying a put, means I am bearish. And if I am selling a put, means I am bullish. To understand options, we can compare it with the insurance. What are options actually? We use it as a risk protection. In case of insurance, the primary purpose of insurance is to protect against financial losses arising from unexpected events such as accidents, health issues. We take insurance policies provide coverage to mitigate the impact of unforeseen risks. Similar way, options can be used to protect against financial losses in the financial market. By purchasing options, investor can limit their downside risk and protect their portfolio from adverse price movement in the underlying assets. As we pay premium in insurance, policyholder pay premiums to insurance company to obtain coverage. These premiums are payments made in exchange for protection offered by the insurance policies. Similarly, in option traders pay premium to option sellers in exchange for the right to buy or right to sell an underlying asset at a predetermined price. The premium represents the cost of obtaining the option and is similar to the premium paid for insurance coverage. Then little bit we have to understand about the moneyness of the options. What is ATM? A call option or a put option is at the money if the current market price of the underlying asset is equal to the option's strike price. Example, if the stock is trading at rupees 100, call option with a strike price of 100 is at the money. If we take the example of Reliance Industries current price was 2716. And predetermined price, it's a strike price are 20 rupees gap is there, 2720, 2740. So which is the nearest? 2716 is the current price. So nearest strike is 2720. That will be considered as ATM. Then comes in the money. What is in the money? A call option is in the money if the current market price of the underlying asset is higher than the option strike price. And put will be considered in the money if the current market price of the underlying asset is lower than the option's strike price. Let's take the example of Reliance again. This is the option chain provided by NSE, and all in the money strikes are highlighted by this yellow background. Like 2700 called if 2720 this is at the money. This is the ATM. Then below this ATM, all will be 2700, 2660, 2660, all will be ITM. And in case of put, 2720 is ITM, and above all these strike will be considered as ITM. Then comes out of money. A call option is out of money if the current market price of the underlying asset is lower than the option's strike price. Let's take the example of Reliance only. See, all this which are in white background, these are OTM. In case of call, all the strikes after 2720, like 2740 onwards, these are out of money. And in case of put options, all the strikes below 2720, these all are OTM, out of money. What are the factors affecting option prices? Number one is current stock price. increase in value of stock price result increase in premium. And increase in value of stock price result in decrease of premium of a put option. Then is the expiration time, expiry. Far off the expiration time, higher the premium of the call option. And far off the expiration time, higher the premium of the put option. We can take this example. Like this is 25th January, 2720 is ATM, and the price of call option is 20 rupees, and price of put option is around 20 rupees buyer, 24 rupees seller. If I change this expiry to 29th Feb, 2720 call price premium is 82 rupees and put premium is 60 and 62 rupees. So far of expiration time, higher the premium of the call option, and similarly the put option. Then price volatility affects the price of the options. Higher the price volatility of the underlying stock, higher would be the premium, whether it's a call option or put option. If there is a fear in the market, price of the option premium will be higher. Then is the interest rate, higher the interest rate, higher the call option premium. And similar is the case, higher the interest rate, higher the put option premium. It's a very important aspect in option pricing, importance of implied volatility. Implied volatility is a crucial component of option pricing models. This is Black-Scholes model. Higher implied volatility tends to result in higher option premiums, reflecting the increased likelihood of significant price movement in the underlying assets. If there is some event like company results are to be announced, implied volatility tends to increase, leading up to major events such as earning announcement, economic reports, or geopolitical events. If there is some event, some election results are about to come, volatility increases and option premium increases. Trader can use changes in implied volatility to assess the level of uncertainty and market expectation surrounding these events. This is the option chain which we were seeing live from NSE side. The option chain is a tabular representation of available option contracts for a specific underlying asset. It is organized by strike price and expiration date, offering a comprehensive view of call and put options available for trading. This is the main ground for every option trader, where one can see everything on real-time basis, be it open interest, change in open interest, volumes, put call ratio, etc. There are many things we can assess from this option chain. This is option chain of Nifty index. It's a comparison table of option buying versus option selling. In case of option buying, we pay the premium. Premium is paid whether we buy call or put. And in case of option selling, premium is received. If we buy options, profit potential is unlimited. In case of option selling, limited to premium received. Whatever amount we have received, our profit will be limited to that amount only. In case of option buying, maximum loss is limited to premium paid. And in case of option selling, it could be unlimited loss. Time value works against the buyer and works in favor of a seller. Win rate, probability of success is low in case of option buying. Option selling, probability of success is high. Margin required is very less in option buying, and option selling, high capital is required. Buying calls versus selling calls. If I am strongly bullish, then I'll buy a call. And if I'm not bullish, I can sell call. Buyer has only right and no obligation, and seller only obligation and no rights. In case of buying, option loses value every day, hence negative, and loses value every day, hence positive. Buyer pays premium, seller receives premium. Limited loss, buyer has an unlimited loss in case of selling. Buyer has an unlimited profit, seller has limited profit. And winning probability is less in case of buying, and winning probability is high in case of selling. A trader sold a call option on shares of a strike price ₹200 and received a premium of ₹12 from the option buyer. What can be a maximum loss on this position? Max loss in case of option selling is unlimited. So objective of option buying is speculative. If one is buying options, he is seeking price movement for potential profit. Option selling is done for income generation, capitalizing on time decay and low volatility. Risk reward profile, in case of option buying, you already discussed limited loss and limited profit potential is there. Reverse is the case in case of option selling. Yeah, this we have already discussed. Directional bias, time decay. These are the example strategy examples. Buying calls, buying puts, long straddle, long strangle. Option selling examples are covered call, cash secure put, credit spread, iron control, etc. And margin requirement in case of option buying is the full premium paid is required as initial investment, and margin required in case of selling are usually higher due to potential unlimited loss. Everybody teaches us that option selling has an unlimited loss. Theoretically, it is correct, but can option selling be done with a limited risk? The answer is yes. Option selling, when done strategically, can be designed to have a limited risk. Strategies like credit spread involve selling one option and buying another to limit risk. Common example is bull put spread, where an investor sells a put option and simultaneously buys a put option with a lower like price. Selling option with a defined stop loss, Example is selling straddles and strangles. The most popular strategy among algo traders with a defined stop loss. We can check it with the option chain. This is a Nifty index option chain. See, if I am bullish that Nifty will increase, what I can do, I can sell a 21,500 put option at 76 rupees and then buy 21,400 put at 50 rupees. So net I'll 76 I am selling and 50 rupees I am buying. So I am receiving 26 rupees. But my loss will be limited. My loss will be limited to, if I deduct 21,400 from 21,500. So my maximum loss according to strike price is 100, but out of that 26 rupees I have already received. So my maximum loss will be 74 rupees only. So this way we can define our risk and maximum loss. In this way we can do option selling with limited risks. Retail traders are mostly option buyers and big institutions are always option writers and sellers. They collect premium and they earn regular income. Because options have a finite value is influenced by factors such as time decay. As time passes, the value of an option diminishes, especially for options that are out of the money. Institutions capitalize on this time decay by selling options and benefiting from a gradual erosion of their value. Large institutions such as hedge funds and financial institutions often engage in option selling as part of their risk management and income generation strategies. Why should we consider options as a trading opportunity? It's provide regular income generation opportunity. Strategy as selling, what called selling ratio spread. The benefit is second, trade with the low capital. Scalping strategies are there, and options are highly liquid. We can design our strategy. Various opportunity permutation computations are available. We can design tailored strategies with a defined risk and reward with high potential returns. Hedging opportunity, we can hedge our portfolio and we can protect our portfolio from downside. Option selling can be done with a limited defined risk. Second learning is time value works against the buyer and works in favor of seller. How do we build option strategies? Building option strategies based on probability. Understanding and incorporating probabilities into our trading decisions can be a game changer, offering us a strategic edge in navigating the complexities of financial markets. What is the game of probability? The phrase game of probability refers to the situation or activities where outcomes are uncertain. In situations where outcomes are uncertain, understanding understanding and utilizing probabilities can be a strategic advantage. What is the probability of winning trades? If we can make winning probability in our favor with a risk-reward ratio of say 1:2, we'll surely make money. Let us take illustration of rolling a die. You have a standard 6-sided die. Each side of die is numbered from 1 to 6. The probability of rolling any specific number on a fair die, say 6, is 1/6, as there are 6 equally likely outcomes. You decide to play a game where you win if you roll 6 and lose otherwise. The probability of winning on any single roll is 1/6, and the probability of losing is 5/6. So how we design a strategy, we'll calculate an expected value. If you were to play this game multiple times, the expected value of each roll can be calculated by the following formula. Expected value is equal to probability of winning multiplied by win amount plus probability of losing multiplied by loss amount. In this case, let's assume you win ₹10 if you roll a 6 and lose ₹1 otherwise. Then we'll calculate expected value 1/6 into 10 plus 5/6 multiplied by minus ₹1. So expected value comes to 1.17 minus 0.83 and comes to 0.33 positive. What's the interpretation? The positive expected value of 0.33 suggests that on an average you can expect to gain ₹0.33 per game played over long run. However, it is important to note that in any single game you may win or lose. Expected value calculation for option strategies. In a similar way, we calculated this expectancy. We calculate expected value based on past historical data in case of option strategies. The higher the expected value, the more profitable the strategy is anticipated to be. In an option trading, positive expectancy indicates a strategy that consistently generates profits in long run. Let's consider another example of rolling 2 dice. When 2 dice are rolled, there are 36 different and unique ways the dice can come up. This figure is arrived at by multiplying the number of ways the first die can come up by the number of ways the second die can come up. 6 into 6 is equal to 36. What is the probability of coming 12 when 2 dice are rolled? See, if we consider what is the probability of coming 12, it's only one outcome is there. The probability is 1/36. It is 0.02. Using probability in trading is one of the example of mathematical models which are used by quant traders like Jim Simon. Jim Simon, the renowned mathematician and founder of Renaissance technology, is a prime example of quant trader who has achieved remarkable success by employing sophisticated mathematical and statistical strategies. You do not need a high win rate to make big returns. Jim Simon models did not need a high winning percentage to make money. If you have 1:2 or 1:3 risk reward ratio, you can make large returns if you do not have any big losses. Example of 1:2 risk reward with a 50% win rate. If I am winning, I am making 100. If I am losing, I have to just give 50 rupees. And if the probability of winning is 50%, and out of 10, if 5 times I am making money and 5 times I am losing, so net I'll earn 250 rupees profit. Similarly, in example of 1:3 risk reward, I will make 500 rupees net. It is the size and frequency of both wins and losses that decides profitability, not just win rate. A small S can make a lot of money over the long term if you keep the losses small. Probability of win ratio and risk reward. It's a quote by Jim Simon. He says, we are right 50.75% of time, but we are 100% right 50.7% time of the time. You can make billions that way. And it's a quote by George Soros. It is not whether you are right or wrong that's important, but how much money you make when you are right and how much you lose when you are wrong. Then another aspect is risk management and position sizing. Strategies where probability of win is almost 100%, like ratio spread. One can deploy large amount of his capital in such strategies. The strategies where win percentage is less, but ROI is higher, like buying futures and put, one need to deploy lesser amount of his total capital. Integrating probabilities using mathematical and statistical models is crucial for designing successful strategies and improving the robustness of trading strategies. India's growth story, with its vast and diverse economy, India has been experiencing a significant economic transformation. India has emerged as a global leader. The world recognizes India as a key player in shaping the narrative of the 21st century. India is not just witnessing change, it is driving the change that will define the 21st century. The 21st century indeed belongs to India. Now, we'll discuss the strategy, option strategy. We can name it as leveraged SIP Nifty. So buy one lot of Nifty future every month like you do in SIP. And buy put option of 0.25% value of Nifty and buying put option, another put option of 0.05% value of Nifty, keeping a profit target of 1.75%. If target not met in the same month, will carry next month, adding loss or profit points incurred in previous months. We will explain this in next slide. You can take a picture of this strategy. This is an example. On 29 September, 9:30 a.m. On the first day of each month, we buy at 9:30 a.m. This is the data of last 3 months. You can take a picture of this. ROI in 2023 was 105%. There is a risk and drawdown in the strategies, so only a portion of funds according to your risk capital is to be allocated in such type of strategies. Take one example on 1st December, time is 9:30 a.m. Expiry is December month. Future purchased at 20361. One put is purchased at 51. Another purchase is 10 rupees. This put we purchase to reduce the margins and safeguard our downside risk. Target 1.25% premium we have paid in buying puts. So in net, our target is 1.5%. On expiry, we leave 9:15 market is open. So we executed this strategy at 9:30 a.m. On expiry 9:30 a.m., the rate was 21,752. And the profit, our target is met in same month. Similarly, in November expiry, the target was met in the same month. And how is month ROI is calculated? Actually, for this, we need less than 50,000 margin. Let's check that in Astra. See, if we buy this future, and buy 0.25% means around 40-50 rupees we pay for the put premium. Sorry. This we do in monthly expiry, 25th January. Let us take expiry of February. Say if we buy a 50 rupees put, so actually we execute this on first day of expiry. January. Now actually we are in the middle, almost 15 days have passed. So otherwise, usually we pay 50 rupees, but I'll show you how the margin is reduced by buying put. See, if I buy this, say 32 rupees, let's check the margin first. See, this margin is showing if we buy one future lot, margin is showing it required margin is 1,22,000. And if we add put in this, say 21,300 put 100 if we buy, and now check the margin required. See, now margin required margin is only 39,000. And we are actually buying 2 puts. So approximately 50,000 every month margin is required. And on the capital of 50,000, we are earning 14,740. Deploying a capital of 50,000, we are earning a profit of 40,000. In the November expiry, we made a profit of 13,770. And let's take one example of October expiry. October, we bought a future at 19,652. We purchased a put of 49 rupees and purchased another put of 10 rupees. Our target was 19,996. And on expiry date, the market actually went down and it closed at 9:30 a.m. It was 8967. So we incurred a loss of 685 points in Nifty. What will we do? We will close that position. We'll enter again. We'll buy a future again of next expiry. We'll buy one put and buy another put of 10 rupees. And in next month, in November expiry, we purchased the future at 19,055, adding our 1.75% target. The amount comes to 19,388 plus 635 points lost in previous month. So our target is 20,073, and next month, like in 2 months, we earned 13,700. So our month ROI was reduced to 13.7%. In such a way, in the ROI in 23 was quite good, but there is a risk in and drawdown in the strategy. So only a small portion of funds are to be allocated in such type of strategies. It's another strategy. Actually, we buy with the 2 lots. We start this strategy with 2 lots. One with the target, and second lot, we don't set any target. We wait till last date of expiry. And in case net profit is less than 1.5%, we'll carry next month. Actually, we assume that Nifty is going to rise in the long run. So like we do SIP in mutual funds, SIP in ETF, similar way, this is a leverage SIP strategy. And let's check the outcome of this strategy, which we leave on expiry. Like in December expiry, December month expiry, we earned 66,500. Monthly ROI came to 133%. This monthly ROI is calculated considering approximately 50,000 margin. So we deployed a capital of 50,000, but see, if market goes down, then we will have to give M2M as well, and we will have to carry again. Every month we buy a fresh lot, and if loss is there in previous expiry, then we carry that. We don't exit in loss. We will keep on carrying this, assuming that Nifty is going to rise in long term. So in December, we made 66,500 on one lot. In November expiry, we made 50,350 in one lot. And in this October expiry, in this also 685 loss was there. We carried that and made on expiry 16,100 profit. So ROI in 23 was 388%, considering amount invested was 50,000 only. Again, I'll say there is a risk and drawdown in the strategy. So only a very small portion of funds can be allocated to such type of strategies.
Sir, may I request
Yeah.
a brief 5-minute break for all to recharge and come back?
Yeah, sure.
So it's 7:30.
Yeah.
We'll meet sharp at
Yeah.
7:36. So take a short water break or whatever you wish to take, and we'll be back at 7:36.
Yeah, thank you.
Okay, so it's time. I hope we all are ready to resume the session. Over to you, sir.
Hello. Yeah, am I audible?
Yes, sir, you're audible.
So, so there is a risk and drawdown in these strategies. So only a portion of funds according to your risk appetite is to be allocated in such type of strategies. And there are strategies where probability of win is almost 100%, but win amount is very less and ranging from 7 to 12% per annum. There are such strategies. One can deploy a large amount of his capital in such strategies, adding 7% interest from that ETF for fixed deposits with a bank or government bond or securities. So its total returns become 14 to 19%, which is quite handsome. Now we'll discuss a little about algorithmic trading or algo trading. Algorithmic trading, often referred to as algo trading or automated trading, is a method of executing trades in financial markets using predefined computer algorithms. Algo trading involves using computer algorithms to execute trading strategies with speed and efficiency. In the contemporary era, dominated by artificial intelligence, the manual execution of tasks seems almost difficult. Just envision the complexity of preparing an income tax return without the aid of software. Similarly, in the realm of trading, algo trading emerges as an imperative necessity in the modern age, driving efficiency, automating calculations, executing transactions autonomously, and ultimately enhancing profitability. Why algo trading is needed? The benefit is speed and efficiency. What computer and algo trading executes trades at a speed much faster than human trader can achieve. Manually, it's just next to impossible to execute strategies. And second is automation. Algo trading automates the trading process, reducing the need for manual intervention. We can't sit all the time in front of a screen. Market liquidity. Algorithm trading contributes to market liquidity by providing continuous buy and sell orders. Next is access to multiple market and assets. If you have designed some strategy, similar strategy we can deploy to multiple instruments and multiple products. Algo trading systems can monitor and trade across multiple markets and assets. And the next is a reduced emotional bias. In manual trading, emotional bias is a great problem. Algos execute trades based on predefined rules and parameters without being influenced by emotions.
Excuse me, sir. Our chairman, Nanda sir, will be joining in between. 1 minute, sir. Sorry for interruption. Madam, please note the same.
Yeah.
Okay, sir.
Okay, thank you. And why algo trading is required? So next is backtesting and optimization. algo trading strategies can be backtested using historical data to assess their performance under various market conditions. Then is risk management. Algo trading system can incorporate a sophisticated risk management techniques. There is market analysis. Algorithms can analyze vast amount of market data, news, and other relevant information in real time. Then arbitrage opportunities are available. Algo trading is well suited for identifying and exploiting arbitrage opportunities where price discrepancies exist between different market or related assets. Next is cost efficiency. Algo trading can lead to cost savings as it reduces the reliance on human resources, minimizing errors, and ensures efficient use of available capital. What's the learning? Algorithmic trading or algo trading can potentially increase returns and earnings through several mechanisms that leverage automation, speed, and systematic strategies, risk management, and emotional bias. How to start algo trading? See, we have to choose a trading platform, select a broker that supports algorithmic trading, then use algo trading platforms. Consider using specialized algo trading platforms or libraries that facilitate strategy development and execution.
Hello, sir. Let's take a small pause for a session.
Very good evening, Neha. Good evening, Nanda Sahab. How are you?
Good evening, sir. Very good evening. I'm fine.
I'm extremely sorry. I was traveling from Guwahati and I've just landed. I'm in the car.
Okay.
So I wanted to compliment. I'm told there are a large number of people have joined. So I wanted to compliment you and the participants. Ladies and gentlemen, the profession now is at all-time high. We have allowed chartered accountants to ultimately trade in future and option segments, in commodity and currency variants. So, ladies and gentlemen, people like Mr. Krishnani, who has lived his life into the markets, can drive you, can put you at a parlous where you understand how to invest in markets, options, calls, and very importantly, I know people now who trade on valuation of options. Greek, what is the premium? What is the, say, the time value? What is the risk? So everything involves a structural movement in creating value and worth. Ladies and gentlemen, I am very keen to ensure that our membership creates a great value by investment in stock markets. I never intended to intervene between the very nice session going on by Mr. Krishnani, rather I was listening to it. But when Neha said I have to speak, I will speak for a minute. So ladies and gentlemen, my best wishes to you. My best wishes to the seminar. Market has two notions. Number one, लोग कहते हैं मार्केट में लखपति बनना बहुत आसान है, provided आप पहले से करोड़पति हो. And the second notion, it says that if you want to become a multimillionaire by legitimate means, the stock market is the only option. Ladies and gentlemen, I'm really thrilled and honored to be amongst you and amongst this session, which will tell you how you could create a larger proposition with respect of smaller capitals. But risk is the buzzword. You may not ultimately go ahead and lose your money. And for that, you have to, ladies and gentlemen, get involved into the system which creates value, whereby you build up capitals. I'll not speak between you, stand between you and Krishnani Sahab, so I withdraw. Please carry on. I wish this seminar all success. Great. Thank you. Thank you so much.
Thank you, sir, for taking out time to join us amid your busy schedule.
Thank you, Neha. I was very keen to join, but due to the constraints of travel, I have joined late. Bye-bye. Carry on, Krishnani Sahab. I'm withdrawing. Thank you.
Thank you for your words. Yeah. So we were discussing algo trading, how to start algo trading. So one was choosing a trading platform, selecting a broker and trading platform. And next is backtesting. So develop a backtesting framework, implement a robust backtesting framework to test your strategies on historical data. we have to design a strategy. Then we have to backtest that strategy on historical data. Now are easily available. Various sites are providing the historical data. Then we have to evaluate performance, assessing the performance of your algorithms based on key metrics, including returns, drawdowns, risk-reward ratio. Then third is we have to optimize parameters. Fine-tune our parameters of your strategy to enhance performance. And then we have to do refinement, continuously refine and improve your algorithms based on backtesting results. Like we calculated the expectancy in one example. Similarly, we can calculate this expectancy value on the basis of past historical data, and we can keep refining until and unless our desired results are obtained. Then is risk management. You have to implement risk controls, integrate risk management measures into your algorithm to limit potential losses. And next is diversification. Consider diversifying your portfolio to spread risk across multiple assets or strategies. So what we do, we run a basket of strategies. Here we run 10, 12, 13 strategies. If one strategy is not performing in one type of market, then second strategy, other strategy saves us from that losses. So we run a basket of strategies. Then is a paper trading. Whatever strategy we designed and backtested on the historical data, if the strategy is successful and giving good results, then we'll do it on simulated trading. We'll practice those strategies on paper trading environment before deploying real capital. And then we have to evaluate result, assess the results of paper trading to ensure your algorithms perform as expected in live markets. After that is completed, then we'll start with a small capital to minimize risk while gaining live trading experience. And then we have to monitor and adjust live strategy closely and make adjustment as needed. So these are the top options available for investing, whether to invest in the stock market, real estate, digital gold, or mutual funds. Investing in FD we consider as the biggest risk considering the cost of inflation. But with options, you can earn additional regular income by deploying almost 100% safe strategies are available, can be designed in options. So if we are earning a 7% return on FDs, by placing that FD, NSE provides the margin for trading in options. So we can generate additional 10 to 12% safe returns. So total returns comes to 17-18%, which is quite handsome. So we can deploy a large amount of capital in such type of strategies. Investing in a stock market versus immovable property comparison is given. What is the risk in investing stock market and immovable property? People fear investing in stock market and therefore invest their amount in immovable property. Let's have some comparison. What are the benefits of investing in stock market? First is initial investment is required very less. You can invest even $100 in ETF. One quantity you can buy ETF, like many ETFs are available. In Nifty ETFs, Aditya Birla ETF is available, which requires only 30-40 rupees. But immovable property investment, lakhs of rupees investment is required. You can't purchase in hundreds or thousands. And return on investment potential for high returns if done strategically. real estate appreciation may be slower compared to stocks. Historically, it is proven that maximum return is in stock market investing only. And then comes liquidity. Generally, high liquidity can be bought or sold quickly, which is not in the case of property. Liquidity is very low. Selling property may take time. The biggest problem is fear. People fear and don't invest in the stock market because they think market may crash, an index fund or ETF value will also come down. But this is not the case. As we have learned, we can buy a protection, we can buy a put, we invest in the stock market and we can purchase a put. Now we'll see how much cost we have to incur in purchasing the put. Before we discuss another strategy, let's discuss what is the conversion strategy in options trading. Conversion strategy is buying a call, buying underlying. It's answer B. I designed this property considering it will be interactive, but due to this, actually, see the answer. I'll give you the buying the underlying asset, selling a call option, and buying a put option with the same strike price and expiration date. We will discuss this strategy in next slides. What is the risk associated with the conversion strategy? It's zero risk, no risk, as it is a risk-free arbitrage strategy when executed correctly. So this was the problem with the people consider investing in stock market, that it may crash, but it is nowadays with the introduction of option, that fear we can manage risk. That fear is now no more. So what is the strategy? Invest in Nifty ETF, say Nifty B's, amount equivalent to 3 lots of Nifty. Like we were seeing this Nifty option chain. This is the Nifty option chain. So what you have to do, invest in Nifty ETF. This is will be like investing in cash, like spot Nifty will be there. Nifty lot is 50 quantity. So what is the Nifty value? It's 21,571, approximately 22,000 we can consider. So 3 lots means one lot of Nifty value is approximately 11 lakhs. So how much we will invest in the Nifty ETF? Say Nifty is amount equivalent to 3 lots of Nifty. Like 33 lakhs we will invest in Nifty, considering that Nifty in the long term is going to increase. And to safeguard our downside risk, we will buy protection like insurance against market crash. But we'll buy 3 lots of Nifty ATM put of December expiry. Now let's check December expiry option chain. See, if 22,000 strike price, it is premium is 816, and 21,000 strike price put premium is 536. So if we invest 3 lots equivalent amount in Nifty ETF, we get 21,000 or 22,000 put equivalent amount of like three equivalent amount of value we will buy. And to safeguard, sell 1 lot of call option December expiry to protect against the loss of premium in buying Nifty. If we are paying premium in buying a put, we may lose that money if market doesn't increase. To safeguard that loss from put buying, we will sell 1 lot of call option only. So our upside is open for 2 lots. 1 lot we have sold the call. Did you get my point? What we have to do? We have to purchase Nifty ETF equivalent to 3 lots of Nifty. Second, we have to do buy protection, insurance against market crash. I will buy equivalent amount of lots of Nifty ATM put option December. Here we can buy 21,000 expiry. This I can show you in this chain. See, in this backtesting, actually Nifty spot option is not there. So we can do like, but we have to buy ETF, not futures actually. Here spot option is not available. So I am adding this 3 lots of future. And see what we'll do. We'll buy December expiry, 26 December, long dated options. Actually, premium is very less, theta is very less, time value is very less. So we'll buy, say 21,000 put, we buy at 536 rupees. We'll buy 3 lots equivalent amount. And we can sell either 1/3 or we can sell, say, 24,000. So we can earn till 24,000 also. We can sell 24,000 call. If we sell 3 lots, equivalent amount even we sell. So what is the probability? And so it was already added. Let me remove this. Wait. It was added twice actually. Here we are doing all equal. We buying 3 lots future, but we have to buy this in cash actually. We'll buy ETF, not future, because future cost of carry will be there. So we'll reduce that cost as well. We'll buy put future equivalent and we can sell. See, if we sell 22,000 call, we are buying put it at 23 and selling call at 1690. Our downside is protected. Probability of profit is 99.5%. Net credit is 1,30,000, which will surely, because our downside is also protected, our upside is also protected. We have sold call, but against this call, we have purchased ETF. And how can we announce the return again? What ETF we purchased, we'll again place those ETF into NSE and get the margin for trading. And we can deploy other option trading strategies where probability of profit is almost 100% in weekly expiries. I hope you have got my point. So there are a lot of strategies and options available Lot of tools are available, lot of websites are available, backtesting data. We can test on any idea. We can build any idea, strategy, and then backtest and then deploy in live markets. Investing like SIP in index ETF is good idea, but if you sold a property and generated cash, say 1 crore, should you invest the whole amount in index ETF? You can buy index ETF, buy ATM put of December expiry. If you check the premium percentage, let's say Nifty is around 21,500 level. And if you buy a 21,000 put, how much premium you have to pay? 536%. So if you calculate the percentage, so on an average, you have to pay 4-5% premium in buying put. And if we don't lose that 4-5% what we have paid for protection, we can sell call option of higher strike, or we can sell 1/3 ATM call. So in both way, we'll earn money. This is the Nifty growth chart for last many years. See, in our strategy, if market crashes like it did in 2008, in 2008, market on 1st January, these are yearly candles. 2008 1st January, market was 6136, and on 31st December, close was 2959, and there was a loss of 51.79. Market crashed more than 50%. So with this strategy, where if we buy a put option and market crashes, that actually is equivalent to a lottery, winning in a lottery. If market crashes so much, so we will receive cash. We will receive cash against put purchase buyers. Say if we are investing 1 crore rupees in Nifty ETF and buying put a December yearly expiry, December month expiry put, we are buying, paying approximately 5%. If market crashes 50%, then we'll receive 50% of amount. Approximately, if market crashes 50%, we purchased ETF equivalent to 1 crore, 5 lakh we paid premium for protecting our downside risk. Market crashes 50%, so we'll receive 50 lakh from put. And 5 lakh we had paid premium, but that premium we set off from selling call options. So we'll receive cash if market crashes. And next year, on 1st January next year, we'll have the opportunity of buying index at a very low price. Like in 2008, close in December was 3179. On 1st January 2009, market was at 2963. So we can invest those 50 lakhs received from put. What we earned from put, we can invest in at the rate of 2963, and we assume that in long run, market will revive. In 2009, similar case we saw in the year 2020, where market crashed from 12,200 to 7,500. In the same year, market revived, and market closed at 13,981, registering a gain of 14.9% in 2020. So in the long run, market has to increase only. But we have to have patience and proper strategies. So if we deploy such type of strategies, like many people fear investing, they prefer investing in real estate, and they prefer the stock market is risky. But with the introduction of options, the risk is now no more. Because Nifty or index cannot become zero, you can average and buy more, say on each 20% decline or 15% decline from the top, according to your capacity and availability of funds. 2020 COVID crash, no one could invest when the market crashed to 7,500 in March 2020. If you get this opportunity, like a big crash is there, big fall is there, actually that is an opportunity. Opportunity what? Like Maruti, like Mercedes, you are getting at a price of Maruti. So you can simply deploy a strategy that on every 20% or 15% fall, you can average, but this averaging you can't do in stocks. Stocks may lose all its value and become zero. Like I myself lost in technology stocks, Silverline and Penta and all that. I lost a lot of money in Ketan Parekh time. But this is not the case with respect to index. The beauty of the index is it automatically rebalances every 6 months. On 1st January and 1st July, automatically, if a stock comes out of top 50 category, it will be out and the new stock will come. Always you will be invested in top 50 stocks of India. Was the learning option trading with its unique characteristics provides us with a tool set to not only manage risk, but also to craft strategies based on probabilities. When were standardized and exchange traded options in the contemporary financial market were first introduced in India? The answer is 2001. When were these options were introduced in the world? It was in 1973. Now commodity options have been introduced in India, like gold, natural gas, crude options are available. The CBO officially opened for options trading on 26 April 1973. First option traded were call options on 16 individual stocks, and this marked the beginning of a new era in financial derivatives. Option trading was introduced in India on June 4, 2001. Since their introduction, option trading has gained popularity in India, contributing to the growth and dynamics of the country's derivative market. National Stock Exchange is the largest stock exchange these days in the world. NSE and BSE are the two prominent exchanges. They are option now. BSE exchange has also initiated options on index. Earlier on, liquidity was not there, but now BSE options are also doing good. And MCX launched first commodity options in India in January 2018. So a lot of instruments and lot of opportunities available. We have to design our strategies accordingly. So here is a little comparison of investing versus trading versus option trading. See, as discussed earlier, that both investing and trading make money. It's individual preference and time horizon and depends on the goal. In investing, it's a long-term perspective. Trading, you can make money in short term. You can make regular money. In option trading, you can earn money regularly on weekly basis. Weekly expiries are available. In USA, S&P, daily expiries are available. So there are strategies where you can make regular money. And there are earning profits flexibility. If market goes against the position, will incur losses in investing. If you are invested in stocks and market crashes, you will lose money. But in trading, if market goes against the position, will incur loss, of course. But in options trading, can earn profit from both rising and falling market. Different option strategies such as calls, put, spread, and straddles enables trader to tailor their positions to specific market expectations. Another benefit in options is leverage, which is not in case of investing and trading. Option provide a form of leverage. Now we discuss the leverage, SIP, Nifty strategies. Only a little margin is required, means compared to actual investing, very less margin is required and ROI can be higher. Then time decay benefit is there. In investing, no time decay benefit. In trading, no time decay benefit. Option strategies can be designed which works in our favor as being option sellers. And option trading works in favor of option seller. So the option selling strategy can be designed. And as we discussed, option selling is not unlimited loss, because we can definitely put a stop loss in our strategies and we can hedge our option selling with another option buying. So lot of strategies can be designed. So why lose money in stock market? It's basically lack of discipline, no study or homework, no strategy, no risk management. They become emotional or getting rich quickly and no patience. Leveraging or over trading, no technology, no backtesting. If we overcome these, we trade with the discipline, study and homework. If we are investing, we build a strategy, backtest, and if profitable, then can deploy. And we can deploy multiple strategies to minimize the risk. So it's very crucial that if probability of win is great, so we can put large amount in that strategy. So risk management is very necessary. This is about beating the stock market. Many mutual funds actually try to beat the stock market index, means benchmark index, they try to beat, but very few succeed. What does it mean? The phrase beating the market means earning an investment return that exceeds the performance of the benchmark index like Nifty or say Sensex. Everybody tries to beat it, but few succeed. But beating the stock market is very easy nowadays. Simply invest in index ETF. Can place ETF with NSE and generate extra income by deploying almost 100% safe option strategies. I told you that strategies are available, like ratio spreads are available, where you earn 10 to 12% safe returns you can earn. Whatever index return is there, that you will get by simply investing in index ETF. If Nifty has given return of say 20%, so 20% return you will get in index ETF. We can place that index ETF. ETF works like stock, as I told you. That will be in your demat account. You can place those index ETF with NSE and get the margin for trading. And against that margin, can deploy 100% safe option strategies. So beating the stock market actually becomes easier with the introduction of options. This is the common dialogue of the film Harshad Mehta Scam. Risk hai to ishq hai. Love often involves taking risk or facing challenges. Genuine love is adventurous and sometimes it requires stepping out of one's comfort zone. There is risk in every aspect of life. Traveling in a car, airplane, train is a risk. Doing own business is a risk. Keeping money in fixed deposit is a risk considering inflation. But options are such a beautiful products which has made risk possible with a defined or calculated risk or almost no risk. This is the quote of Bruce Lee that you must start somewhere. If you spend too much time thinking about a thing, you will never get it done. And that's all from my side. Now session can be open for question and answer. If people have some questions, they can ask.
Thank you, sir. We have few questions. One is, sir, can you please guide from where we can start if we are beginners?
Yeah. Okay, I told you there are many strategies. Even if you have money, you can whatever you are earning from fixed deposits, that you will keep on earning. Whatever interest you are earning, you can get it from bank. You can place those fixed deposits with NSE and get margin. And against that margin, there are a lot of strategies which can be designed in options. So additional income you can earn means 10 to 12% easily. Strategies are available, like ratio spreads are available, where probability of win is almost 100%, 99.8% means there is no risk. Such strategies are available.
Okay, we have next question, which is, can you please explain ETF in layman language?
ETF is like an exchange traded fund. It's the same like, let me go to the previous slide. See, like Nifty index is available. There are so many ETFs available. We consider investing in Nifty as a surface. So Nifty, it's all detail is available if you search in Google. So whatever ETFs are available, ETF means traded like a stock. Like you are buying a stock, similar way you can buy a single unit of ETF. Like you are purchasing like a Nifty. If you are purchasing a 1 unit of ETF, Nifty B ETF, Nifty B requires approximately 240 rupees. It currently at 240 rupees. If you are purchasing 1 unit, means 240 rupees you have invested in 50 stocks, 50 top stocks of India. So that facility is now available. ETF are gaining popularity these days. You consider simply as a Nifty index you are buying. And the SEBI has allowed means you can trade in those indexes like similarly like you are buying and selling. Whenever you can buy and whenever time you wishes you can sell. This is no difference. It works exactly like stocks.
Okay, next question we have. What is the strike price of PE option to buy?
See, we prefer ATM actually, but now we prefer if a market is at 22,000, we purchase 22,000 strike put December expiry. Usually in a yearly, long dated this yearly expiry, put option is available at 1/3 price of call option, ATM. If market is 22,000, so put option will be available around 600-700 and call option will be 3 times higher. So we prefer buying, you can means because if you see the option chain, In long dated expiry, like I'll show you this, or let me count the option chain from NSE side. See, if we check the January 24 expiry, see this strike price every 50, like 21,550, 21,500, 21,450, different strikes are available. But in case of long dated options, if we check the December 24 expiry, only 21,000 and 22,000 expiry, means in between it's not even 21,500 expiry is not available. So we can check like 21,000, we can check 22,000, we can check. Like I was showing you this. In this we had done 22,000 put we had purchased, and similar 22,000 call we sold. And probability of profit is 99.5%, and there is never it is showing a loss. And this credit we have received, this is our earning, because we are protected. And this ETF we can place again and deploy other strategies, we get the margin. Here only two options are available. See, Nifty is at 21,500, but we can design a strategy with 22,000, or we can purchase 21,000 also. That is available cheaper. And then we can do 21,000 and we can reduce the quantity.
Sir, I think we're able to see the screen why people lose money in stock market if you're sharing something else.
Yeah. 1 moment.
Okay, moving to the next question. Most of all of us loved the presentation and the PPT, so they're asking if they can get the PPT.
Yeah, I can share the PPT.
Okay.
Yeah.
Another question that we have is, can you please suggest few sites or platforms where we can devise and backtest our strategies?
Many sites are available, like it depends on, the coder use different site. I use like Ostra in this simulation, in this option simulator, but this is a manual backtest. Here we can backtest our strategies, like 4-5 year data is available in this. We do backtesting in StockMock as well. StockMock is available. Zerodha Streak is available. See, I'll open this. Stockmock.in is available. Stockmock.
So we can
here we design strategies. Yeah.
So we can see only a PPT presentation. We cannot see anything else.
Okay. The site I am opening is not available.
Not
visible to
visible,
you.
Sir.
Okay. Okay. So stockmock.in is available. Streak is available for backtesting. For manual backtesting, we use Ostra.
Okay. The next question that we have: which strategy is better when market opens next day at 1,000 point up or down, so that the loss can be minimum?
Market, see, there are a lot of strategies. Now we can't discuss that much of strategies. So actually, we design our strategies which are mostly safe. Actually, time value, we earn, like a large institution are option sellers. So similarly, we design our strategies of based on time value. So we don't do strategies which are directional. Otherwise, the strategy which I discussed, those are safe, investing in Nifty and buying a put. So we deploy only strategies which are safe.
Okay. Next question that we have is, please explain working of profit and margin in options and put.
Please come again.
Please explain working of profit and margin in option and put.
Working of profit in
Profit and margin.
and margin in buying puts.
Yeah, in options and put.
Actually, I didn't get your question.
Maybe they want to ask in buying the put.
No, buying the put. If we are buying the put, only the amount of premium we are required to pay. No margin is required. And if we are selling put, then margin will be required. And that margin usually means it keeps on changing. And I see even in the daytime margin is changed. Because if we are selling, then our risk is unlimited, so margins are higher. If we hedge against, if we buy another put, we hedge our strategy, then margin are reduced. It's automatically calculated by NSE and provided by margin files are provided by NSE. But you can have an idea, like you are saying it's obstra, this is not visible to you. The complete screen sharing can 50 to 80,000. If we are selling one. If we are selling, means margin depends on which strike we are selling. If we are selling ATM, margin will be higher. If we are selling OTM, margin will be less.
Okay, we have next question with us. Please tell one of the easiest strategy which may work most of the times.
These safest strategy are ratio spreads for earning regular income.
How to
ratio
avoid
spread is buying. Yeah. Ratio spread is like buying one lot of call option and selling 3 or 4 lot of call option or 2 lot of according to the risk appetite. So that can be done. Similarly, buying one put option of near strike and selling like if Nifty is 21,500 or Bank Nifty is say 46,000. So buying one lot of Bank Nifty at 49,000 and selling 2-3 lots of 49,500. So that is ratio spread.
Okay. How to avoid premium decay in options?
Premium decay in option is going to happen. If you are option buyer, then you can't avoid this decay in buying. If you are buying whether call option or put option, see, premium decay will be there.
Okay. Through Gift City, how can we invest in US markets?
See, if you wish to invest in US market, so you are asking means Gift City, like they are a broker registered in Gift City. It is similar, like means they have allowed few stocks you can invest, but it is considered as investing in dollars, and RBI regulations like LRS scheme up to 250,000 per annum you can invest through brokers in Gift City.
Okay. One question is, Infosys shares price is visible and transparent. Is ETF also similar to price, differs based on mutual fund house offering it?
No, no, I didn't get you. Means Infosys and ETF. ETF, see, ETF are means for available for again for indices like Nifty or Nifty mid cap. It works similarly. Like you are buying Infosys, similarly you buy ETF. If you are buying Nifty ETF, it's similar like buying Infosys. Process is similar, but your portfolio is diversified actually.
Okay. Any good reference books for value investing or fundamental technical analysis?
No, I don't recommend any.
Okay.
For learning, a lot of information is available in YouTube. It's free of cost. But you have to consider risk management, primarily focus on risk management.
Any option expire, it has time value, that is near month, etc. Does ETF also work or has expiry date?
No. ETF is like investing. It's a similar like you are purchasing stocks. It's a similar like if you are purchasing ETF, means it's similar like you have invested in top 50 stocks which are forming index. If you are buying Nifty ETF, means you have invested in all the stocks of Nifty ETF, Nifty index.
Okay. Another person asking is, which course is good with CA to become a hedge fund manager, sir? Any course that ICI has related to capital market, commodity, or forex?
ICI? No,
Yeah.
I'm not aware of. No, I'm not aware of any course.
Okay.
For becoming hedge fund manager, I am not aware of any course.
Okay. We have next question is, approximately how much premium is safe at times of writing monthly calls or puts?
How much premium is saved? No.
Safe. How much premium is safe at times of writing monthly calls or puts?
No, you can't say how much premium is.
Okay.
It depends on the market volatility, VIX, and many factors are there. So many factors affect this option premium. So no one can estimate how much writing is safe. You have to design your strategies accordingly. You have to design your strategies safe.
Okay, that is it. What we have for the question and answer, sir. Thank you so much, sir, for your insights and learnings that you've shared with us. As we draw the curtains on the enlightening webinar on the options and algorithm trading, I'm filled with a sense of gratitude and inspiration. Today, we've had the privilege of delving into the depths of knowledge and expertise which you shared. The insights and the learnings have, undoubtedly enriched our understanding and opened new horizons in the realm of market trading strategies. And I would also like to express a thank to each participant, as your engagement and thoughtful questions have added depth and diversity to our discussion. It is through such collaborative efforts that we can continue to foster a community of learning and growth. So thank you once again to everyone involved in making this webinar a resounding success. Good luck for your future endeavors. Thanks, everyone.
Thank you.